The Federal Reserve is intensifying its drive to tame inflation by raising its key interest rate by 3/4 of a point. It's the largest hike in nearly 3 decades, and the Fed is signaling more large rate increases are to come later this year. Right now, there are no signs of inflation slowing down, with the average U.S. family spending nearly $350 more every month to buy the same amount of goods they bought last year. But raising interest rates is a difficult balance. The higher rates make it more expensive to borrow money, with the hopes that people will eventually spend less. Now, the downside is it could slow down the economy, which economists say poses a risk of a recession. The interest rate hike means if you have a balance on your credit card, you'll soon be paying more to pay it off. KENS 5 consumer reporter Nicole Kahn joins us to explain ways to ditch the higher debt. Nicole?
And that is more important than ever right now, Deb. Credit card interest rates are usually variable. So look for your interest rate to increase by July or August. That means you'll likely be paying $65 to $75 more on your total balance. Now is the time to act, so higher interest rates don't dig you deeper into debt.
Credit card debt can be some of the most expensive debt, says LendingTree's credit analyst Matt Schultz.
Credit card interest rates are already ridiculously high. They're up around 20% on average. The Fed raising rates is not going to make things any easier for the average person with credit card debt.
Credit card interest rates could be up to 21 or 22% by next year. Now is the time to reduce that debt. Transfer your balance to a card with an introductory 0% interest rate or one with a lower interest rate than you have.
That can still really add up and reduce the amount of interest you pay and reduce the amount of time it takes to pay off that balance.
Make extra payments if you can, says financial advisor Carl Eggers of CapTrust.
So high, that probably is the first thing you should do with extra cash is to pay that down.
Consider a personal loan to pay off your credit cards. Be sure the loan has a fixed interest rate that is lower than the one on your credit cards.
Because not only does it allow you to reduce your interest, but it can just help you streamline your payments overall, because you could potentially consolidate several credit cards.
Or try this trick.
Call your credit card issuer and ask them for a lower interest rate. Far too few people do it.
They want you to continue to pay interest to them. So definitely try to negotiate that interest rate.
It works 70% of the time.
Higher interest rates are, of course, bad for debt if you're carrying it, but they also mean you'll be earning more money on your savings. Nicole Kahn, KENS 5.